Welcome to TheoTRADE. This is Don Kaufman. It's May 10th, 2024. Just about 5 minutes stands between us and the weekend. Markets coming to a close, and yeah, they couldn't be closing soon enough because if you thought markets sucked this week, you're right. I mean, look, this is all about one-sided trade lately. Again, I know that some people are probably tuned in right now thinking, like, I had a spectacular week. Maybe you did have a spectacular week, but as a trader, what do you want to see as a trader? You want to see two-sided trade. Everything we're seeing lately. Talking about markets is like almost like talking about politics lately. It's all completely one-sided. It's wild. It's totally binary. Either we're straight up, we're straight down, we're straight up, a glimmer of hope of volatility, straight back up. It's really been wild. Very, very, okay, one-sided trade. And yes, we've had some recent volatility, but all of a sudden, okay, the vacuum comes in and we snapped right back to a degree of complacency. In fact, we're going to discuss that complacency. Okay, we're going to discuss expected moves, which in my opinion are far too low. We're going to look at bonds and dollar, and obviously got to talk about some of the economic numbers that are coming out, which kind of begs the question: when is bad going to be bad again? Anyway, with that, let's start to break down some of the action in the marketplace and then look forward, of course, to next week. And you got CPI coming out next week. That's going to be an interesting catalyst. To begin with here, let's go to the mother of all products, the SPX. And the reason I like to look at the SPX, I wanted you to see, yeah, we shattered the upside of the expected move. Now, we're going to mention this a couple of different times because there's a lot to unpack in a marketplace that, on one hand, I'm like, well, it's kind of complacent. The idea of complacency, though, lies in like, how did the VIX get back down to 12.5? Even though I am saying that it's complacent, okay, the volatility says it's complacent. On the other hand, am still looking at this and saying like, this is all wrong. The expected moves are just like, they're simply too low, in my opinion. And I really, as I said, I want to kind of unpack this because even though everybody's so directionally biased, we're going to hit new highs, Don, we're going to do this, okay, we're going to do that. Push all that aside for a second. Don't you see what's going on here the last couple of weeks? Like, and again, what is going on here? As I said, I'm going to kind of unpack this for you, right? That is a breach of expected move to the downside at the end of the week. Got it? Then we have a consecutive week breach, okay? Last week we finished the week marginally higher. And now here we are, okay? A breach to the upside. Now, any way that you want to present this, it doesn't matter. I don't care whether you're bullish or bearish. I have skin in the game, okay, for bullish or bearish. I've got some bearish positions on, but that's not the point over here. The point over here is you do realize that the SPX, with billions of dollars being traded on either side of this, are continuously shattering through expected moves. And consecutive breaches of expected move are very much indicative. And the way I always think of it, it's like the market is getting torn apart. And when I was saying, and again, I think it's an opinion, the expected moves are too low. That is an opinion, all right? But it's an opinion based on like looking at this, like, look, this past week of trade had roughly a $62 expected move. That means you're supposed to move $62 higher, $62 lower. Did you watch Monday? We basically, almost hit the upper edge of the expected move. And this entire trading week, all we basically did throughout the course of the week, and look, I'm going to actually drop this back for a second in time frame. We're going to actually go back to like the last 5 days. Okay, flip this over to like a 5 minute, hit okay. All we did all week is like, on Monday, we jumped higher. By Tuesday, we hit the upper edge of the expected move. Wednesday, okay, we're riding the expected move. On Thursday, a mild breach outside of expected move. And here we are on Friday doing absolutely nothing. Moreover, we're doing absolutely nothing on what is incredibly low volume. So the S&Ps, which are closing right now, but the S&Ps, they're lucky to do 1 million contracts. Now, again, I'm going to bring this up for just a second, because if you look over the last 3 years, okay, we're looking 3 years. That's it, people. It's over. And if you missed it, well, I wouldn't say you were missing anything. But if you take a look where my mouse is, in fact, I'm even going to draw a line specifically on this at the 1 million contracts. Okay, that is what volume has looked like. Right down here, that's right down there, that's where volume it has been, okay, for, well, the last couple of trading days. What's the last few days? For the most part, this entire week has actually seen maybe 1 million contracts. It's anemically low. And, I actually was talking to a trader the other day, and he's like, it's summer trade. I'm like, man, it just turned into May. How are we in summer trade already? We're not, okay? There is an unusual degree of complacency in the marketplace. And with that degree of complacency, okay, has, by means of if you look at VIX, the VIX has been crushed back. But at the same time, we're talking about the VIX being crushed back. You do realize that the S&Ps, okay, are still pointing to what I would term unruly moves. Again, there's one thing we have tracked for years. We started tracking expected moves in the SPX back in 2017. All right, and I'll pull up 3 years. Okay, then we'll even come in here and shift the time frame. Okay, go back even 10 years, and I just want to show you. Okay, and again, for 10 years, obviously it's a daily chart. I have to scroll all the way back, but you can see in 2017 when they started putting in weeklies and so forth, we really started tracking. And the one thing in any given year that you'll see is when you start to breach expected move, there's often consecutive breaches, and the markets go from periods, okay, of extreme efficiency, okay, to some wild inefficiency, if you will. This year, okay, has been rather efficient. If you look at the year, there was a breach, nothing, mild breach, very mild breach, okay, a whole lot of nothing. And then all of a sudden, okay, in just the last few weeks, okay, there's a candle that's going to be highlighted here. Again, 3 out of the last 4 weeks have been a breach. What does it effectively mean? Okay, that we are actually in the midst of a fairly extreme marketplace, that we are actually in the midst of what we would term volatility. And of course, but the VIX is a measure often of downside price action, because that's what drives VIX. VIX is a function of SPX. We're looking at the SPX, right? So we're looking at the SPX. VIX is just a function of SPX. And the SPX right now is some unruly moves, but those moves to the upside. To the upside, no one runs out there and buys puts. So the VIX actually falls. Okay? An unusual degree of complacency. And I'm going to further that by saying this. All right. So we're not going to have to do too much of an update here about expected moves towards the end of this. But if you look 7 days out, you realize that the expected move, and this is not set in stone yet. It's not set in stone until about 15 minutes after the close. But we're looking somewhere right around a $67 expected move for next week. Next week actually carries the CPI. We've seen markets move more than that on just the CPI print. It's a lot to think about on that front, right? So back to complacency, expected moves are low. What does that amount to for you? Okay, I'm going to jump to the spiders for a second because I really want to get this into context. It simply means this for you. If you're playing the TheoTRADE at-home game, do not dare sell short-dated options. Okay, it is an absolute, unequivocal death wish to sell short-dated options. Well, why? Because what do you think expected move represents? Okay, it's the movement of short-dated options. If you take a look, I'm going to pull up auto expected moves, but if you take a look at the auto expected moves here, if you sold straddles or strangles, the upper and lower edge of an expected move are basically your break-even points. So you have, multiple weeks here where you're getting killed, people. You just, you're getting killed in multiple weeks. Like, wake up. What I'm saying is the volatility, the juice, which is volatility, is not worth the squeeze. If you look even like to, May, May 13th here, all right? Look how low some of the volatilities happen to be. It's ridiculous. Let me cruise back over to the SPX. The spiders, look, the spiders is a retail friendly product, but the SPX really is, as I often say, it's kind of the mother of all products. But nevertheless, as you start to kind of dig into this just a bit more, I just want you to see, like, how can you get excited about that kind of price action in a marketplace, like a $21 expected move and a 5.58 vol? You have to understand something. The volatility really can't go any lower. It can only go higher. Why would you ever consider selling it? 0 DTE is a buy right now with both hands. It's a buy. Short dated options, you can't sell them. And you go, well, then who is selling them? Market making firms, dispersion traders. Okay, they go out there and they sell huge amounts in the SPX, turn around and buy things like call options inside of NVIDIA. Okay, NVIDIA though, I'll show you something interesting. NVIDIA actually stalled this week completely. That trade would not have worked this week at all. Anyway, with that being said, let's continue onward and upward over here because, back to complacency, expected moves feel very, very low. And that's, to me, it's one of the critical themes in here. Now, one of the other critical themes is when you start looking at the S&Ps and you're like, but we rallied and I like it. Yeah, but the question is, what did we rally on? And this is where we say, financials to the rescue. Now, have you known financials to the rescue, okay, lately? And the answer is no, not really, okay? I mean, what's really led markets, for the last couple of years? Technology. And all of a sudden, the financials, and I have to tell you, this one really does surprise me. The financials, which had a wicked sell-off, huge bid back, faded hard, exploded back onto the scene. Okay, I mean exploded back on. This one is worth bringing up the expected moves as well. Okay, I don't use that term exploded back on the scene very often like this, but it's like a 2 standard deviation move. And the reason I'm like almost dumbfounded by this one is because there's nothing in there, like there's nothing newsworthy like in the financials. There, well, interest rates, what? Come on, I know what you're going to say. Interest rates are going to be higher for longer. No, they're not. All right, the Fed Fund Future shifted this week, okay, to lowering rates. That should really, that's not going to help the financials. That hurts them. Okay, we're also looking at pretty astounding amounts of credit card debt. That information came out. Right. We're also looking at consumer confidence, which came out. See consumer confidence, for those of you that actually know and look at the consumer confidence, look, I don't buy into any of that stuff. The consumer confidence that comes out of the University of Michigan is a sentiment indicator, okay? It was horrific. And that's why I'm asking the question, all of a sudden there's horrific data that came out about the consumer. Don't worry, the financials are going to be fine. Look, the marketplace is bid. It's a little bit too complacent. I'd be on my game at this point. I think that's what it adds up to. But financials to the rescue isn't really more of a statement as it is much of a question mark in there. And you start to look at individual, financials. When I say look at an individual, I'm like, look at Goldman Sachs. Okay, huge break to the upside. Look at how that's 3 consecutive weeks. Well, if you count earnings, there's 1, 2, okay, 3. Technically, if you count the earnings week, that's 4 consecutive breaches of expected move. That is a sick statistical means. Like just wild. I wouldn't even count the earnings week. I still think 3 breaches of expected move to the upside is quite stellar. Okay. You look at stuff like JP Morgan, also the bid back in here, phenomenal. Wells Fargo, the stock that nobody wanted to touch that apparently everybody has to own right now. Look at this thing on a year-to-date basis. These are unruly moves, probably very much unwarranted, because if we're looking at things like consumer confidence that are starting to weaken substantially, and there are many indications of this. You don't have to look like, listen, don't look at a consumer sentiment survey. I'm going to get that one out. Look at stuff like Starbucks. Tried for the corner and missed. This thing got hammered lately. And I keep bringing up Starbucks because there's a number, okay, of restaurants, right, that have actually mentioned like the consumer is in trouble right now. And then we see a consumer confidence number. And it has me asking, when's bad going to be bad again? Now, think about that for a second. When's bad going to be bad, and when's, because good is bad. I also wanted to bring this up, which is this is the CME groups. It's the FedWatch tool. And what the FedWatch tool basically does is, just taking a quick glance at it, the FedWatch tool shows you this is where rates currently are, this being 525, 550. By the September Fed meeting, okay, we're now pricing in a cut again. Now, this is, again, we're all over the place. Markets right now they're all over the place. But again, if you're cutting, how is that good for financials? And meanwhile, the financials rallied this week, right? One of the things that we want to look for in this marketplace, okay, outside of, what sectors are driving things. And again, you can bring up the QQQ here, the NASDAQ, and you can say, well, look, the NASDAQ this week, okay, hit the upper edge of the expected move. The SPX broke the expected move. And that's saying a lot, because it's not some of the NASDAQ stocks that are in the leadership role this week. If you look at stuff like, Microsoft hit the upper edge of the expected move. Okay, Apple actually finished the week a little bit lower. Amazon finished the week almost unchanged. Google almost unchanged. Meta, okay, what do you got out of Meta? All right, you got me here. It broke the upper edge of the expected move. And last but not least, NVIDIA. NVIDIA almost unchanged. And again, I wanted to bring this to your attention because all of a sudden the leadership role comes out of a completely different place. Okay, is the marketplace strong? Or maybe the financials rallied this week and tech comes on strong next week. Next week, though, again, with CPI, it's going to be a little bit dicey out there. One of the key changes you want to look for in the marketplace, we're starting to see some firms that are coming out, okay, with lower guidance. Now, again, it's very individualized, things like Starbucks, and you actually heard from Intel, and it's across an incredibly wide spectrum, right? But those are individual companies, and the individual companies get punished when they actually have a bad forecast. But the whole marketplace is applauded and rallies, okay, when we get bad data. Well, today, though, that consumer sentiment survey came out, again, to point this out, because I thought it was very, very interesting. The consumer sentiment survey comes out, and the markets actually dipped, okay, on it. Nothing considerable. But, all right, this is going to be interesting in the days and weeks to come, when all of a sudden good data can be construed as good and bad data can be construed as bad. Meanwhile, we have a CPI print coming out this week. I've heard on both sides, there are brokerage firms that are screaming that the CPI print's going to be hot, that inflation's not dead. And there's brokerage firms that are screaming that CPI is going to come out rather weak. One of the things that I'm going to tell you right now, I don't care which one is actually going to be right or wrong. What I care about is how the market's actually pricing the action. And the market, okay, it's not pricing much of anything. As I said, right, to kind of wrap this thing up a little bit, you're only looking at a $67 expected move, and that seems egregiously low. $67 a movement, okay? You had trading sessions this week that had that kind of price action. So I strongly urge you throughout the course of next week, if you're going to be, all right, in short duration options, that you best be on the buy side of that. Because this kind of complacency, as I said to begin with, it sucked this week. It just was killing me in low volume and so forth. It's not the way it's turning out next week. Next week, I think you can expect a couple of bangs and some significant movement back into this marketplace because, again, in summation, you have to recognize the bonds, yeah, they moved up and flattened out. Still a very, very dangerous place. The dollar sold off nominally within a stone's throw of breaking back to highs, okay? And those now feel like the new volatility indicators for the marketplace. Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.